bring in our first guest for the hour. We've got David Traynor, New Construct's CEO. And David, you've been listening to us sort of break down the numbers here. I mean, it seems the common thread, at least with Goldman and JPM, is really about the trading volume being down. But as Brian pointed out, we saw both banks sort of make up some of that lower volume in a big way. In JP Morgan's case, we saw the reserves being released, providing a big bump. In Goldman's case, we also saw a big bump in the investment banking side, too. How do you look at the two big banks right now, and what stood out to you?
Look, I think these are the best in breed banks, and that they are not just best in breed in the U.S., but in the world. We've seen the European banks cede market share, and the Asian banks, for that matter, cede market share in the capital markets to the U.S. banks as they've withdrawn mostly. And look, JPMorgan, Goldman Sachs, these are not high-flying tech growth names. I like to think of these as more of like almost the replacement for the index fund. You're going to see lower beta, I think, in these stocks, and they're going to generate more cash flow. I feel like some of the traditional index funds have been sullied by taking positions in Tesla and Netflix and Salesforce, perennially unprofitable firms, and that's made these indices a little more volatile than I think they need to be. Whereas these banks, look, they've got a lot of diversification, as you said, trading, investment banking. That's cyclical, and the second quarter is always soft for these firms. But the lending businesses, and I think that the DeFi movement, these are things that Goldman and JP Morgan are uniquely positioned to benefit from long term because of their customer relationships and their war chest of capital to go in and strategically buy themselves into that movement. So I like these stocks a lot.
I guess I wonder, what does this, liking these stocks tell you about the value trade at large, though? Obviously, financials have been associated with being a staple for value investing, but at the same time, there are different dynamics at play, specifically with the large banks than in other parts of the value world. One example being just the need for clearance from the Federal Reserve for those buybacks and dividends, which only happen once a year. We already got the Federal Reserve's blessing on the amount of capital. That's why we've seen dividend increases across the board. But is there something to be gleaned that, just because JP Morgan Chase, the large banks, are outperforming the SPY year to date, doesn't necessarily mean that's a green light for all of value?
No, I agree with that. Look, I think we're definitely at New Constructs do not believe in theme investing. We don't think you should paint multiple stocks with the same brush. Every company is a different story. It's important to understand the underlying dynamics of the cash flow of each company. Look, and our research shows that, most of the companies in the S&P 500 are either overstating or understating their earnings by more than 10%. So you got to do the diligence to understand the real numbers. And so we make a big distinction between JP Morgan and Goldman Sachs and Wells Fargo and Citigroup. We don't think you should buy those. We don't think those businesses are doing nearly as well. Weaker culture, weaker business, declining cash flows. Bank of America is kind of in the middle ground. So, I think you make a great point. These are kind of value stocks, and they suffer from what value stocks suffer from in terms of not being as popular. But at the same time, they're much safer. They're lower beta. They're generating real cash flow. I think the regulatory oversight, right? That's all priced in. We know the role that the Fed's going to play. They're not going to hamstring these guys any more than they already have. And with Goldman and JP Morgan, they've got more than enough cash flow to pay out huge dividends and huge buybacks, way bigger than what you're going to get across the S&P and almost any other index fund for that matter. So, I'm a big fan of diversification, but I think with these kind of stocks, right, that are trading so cheap and generating so much cash flow and have so little risk, it's just really attractive.
David, I want to get back to your earlier point about some of these big banks being potentially a replacement for index funds, largely because, as you point out, a lot of these funds are now invested heavily in growth stocks like Tesla. I wonder, when you look at the environment right now from a broader context, do you think it's a better play for investors to go for individual plays instead of the broader funds? I mean, how do you think they should be looking at it from a strategy standpoint?
Yeah, it's a great question, right? Because we know active management has underperformed significantly for a long time. And now passive management is such a crowded space, right? That everybody's in it. And so, where do investors get alpha these days? And I do believe we're going to see a return to the good old days when you did your homework and understood individual stocks and didn't just trust that blind diversification was better than investing in individual stocks, because that's most of what you're getting in sector ETFs and index funds. It's just blind diversification. Blind. You've taken everything, including incredibly unprofitable companies like a Tesla. And I think that's going to come back to bite these index funds. And I think investors are better served by strategically putting their money in smart stocks, high cash flows, cheap valuation, strong business model. That's where you've always wanted to be. And we've moved away from that because active management didn't do it. So you can trust mutual funds. They told everyone to go into index funds and passive funds. And now that's a crowded space. And those funds are now sneaking in growthy stocks, risky stocks. So I think investors are left with no choice but to do their research and understand individual names better, or create their own funds, which you can do very easily, right? There's no reason to pay someone to bundle securities for you anymore, right? Create your own fund and create those funds based on high quality earnings criteria that are superior to what these momentum chasing funds are going to go after.
Good takeaways there. David Traynor, New Construct CEO. Always good to talk to you. Appreciate the time today.